Welcome back to Selling Your Business with David King. I'm David King, and I'm the author of Selling Your Business, Begin with the End in Mind, and it's available on Amazon. Today, I've got the pleasure of being joined by Kirk Michie, the founder of Candor Advisors. Welcome, Kirk.
Thanks, David. Good to be back with you.
Kirk has been with us before, and we spent a little bit of time talking about his background and the services that he offers today at Candor Advisors. But we'll summarize quickly here that Kirk has got an extensive career in finance, over 30 years, dating back to his finance degree at USC. He's worked in private equity. He's worked in financial advisory services. Kirk, do you want to flesh that out at all in terms of what you've done and what you bring to the table?
Sure. Candor provides transaction advisory services to successful founder-led businesses. For the 30 years, I've been working in finance and, I would say kind of M&A. The last 10 or 12 have been specifically focused on either buying businesses or helping founders sell businesses. So Candor, supports businesses in kind of all facets of transactions, David.
Our motto is talk to Kirk first. If the owners of a business have an inkling that there's going to be any sort of change in ownership within the near future or even an extended plan, you're going to have a range of alternatives. You might have some sophisticated buyers on the other side of the table. You need to be prepared for this, and you need to assemble the right team of people to help you with the transaction. Kirk, let's talk about different types of buyers of businesses and what a seller can expect when they're doing business, doing a transaction with one of these types of buyers. First off, why don't we define the space, the size of businesses that we're talking about here is our hypothetical business. What's the typical size business that we're serving here in these types of transactions?
Yeah, so I would say it's solidly lower middle and middle market, right? So think about anything from around, 10 to at least 50 million and above in sales, and then probably 2 million or so in EBITDA, up to around 8 to 10 million of EBITDA. And for the folks that aren't immersed in M&A every day, EBITDA, or earnings before interest, taxes, depreciation, amortization, is another way of just sort of thinking about the transferable economics of a business, or in shorthand, if you don't have debt or kind of heavy property, plant, and equipment, it's just your net income, or roughly that number.
How often do you meet with owners of a business and they start out, can you help a business that's worth X million? And they haven't really had anybody look at their business yet to give them a realistic idea. And they may be worth far more than what they're thinking. It's often the other direction. But how often do you say, well, actually, you've got a bigger fish here than you thought at the beginning? How often do they just come in with an idea of what they realistically expect without just saying, these are our financial results?
Yeah, so I think most founders don't necessarily, like, they might have an idea of what they'd be willing to sell for, or without data to back it up, a viewpoint about what their business ought to be worth, but they don't in many cases understand the way that the market, if you will, would value their business. And for them, the good and bad news is that you're going to get paid essentially a multiple of your financials, kind of discounted by the likelihood that they're not going to continue, or increased by the likelihood that they are recurring and growing, right? And the market gets to set that number. And if you're a founder, that will be frustratingly disconnected from what you think is special about your business. Which isn't to say that what's special about your business won't matter. It's just that it's going to matter at the edges or in terms of differentiation, or maybe, in kind of modest iterations of valuation. So, and look, sometimes, especially lately, with so much M&A activity and so many buyers out there and so many different vehicles to buy companies, sometimes sellers are surprised on the upside, at least right now.
Yeah, these days there's often some pleasant surprises out there. Well, let's break it down here. If we got a business and it is a good opportunity for them to explore a sale of any form, there may be a range of different buyers, and let's just lump them together for simplicity's sake into strategic buyers, another acquiring company that will come in and acquire them, either because they're in the same market or they're in a complementary market. And then financial buyers, private equity firms, family offices, and then lastly, kind of the other forms of transactions, the SPACs, the ESOPs, the kind of non-conventional exit structures. Let's start with probably the simplest, which would be a transaction with a strategic buyer. If you're working with a company and they're potentially going to be acquired by a strategic acquirer, what should they expect? How should the negotiations work? Those sorts of deals.
Yeah. So strategic buyers are going to be companies that are in your same business. Like you said, they are companies rather than investment firms. They might be bigger versions of you, or they might be, the version of your business that's in a different geography and they want to acquire your geography, or they're adjacent to your business and they want to acquire your customer set or kind of your product or, service set. Right. And for those kind of transactions, they're growing kind of inorganically by doing M&A activity. And you're usually going to be contacted by, the head of corporate development or, a kind of a business person at the company. And when that outreach comes, minimally, they need to talk to someone with your skill set, David, even if they think that's the right buyer. They need to protect themselves for, kind of ongoing liability and make sure that the deal is structured the right way so that they get the proceeds they're thinking that they get, that any contingent proceeds they might get are well explained to them and understood by them. And, in those cases, even though it's rare that somebody's going to get all of their money in cash and get to just, kind of point out where the extra set of keys and the cleaning supplies are, and get to ride off into sunset, even though that's a rare thing in transaction, a strategic buyer is likely to buy 100% of the business, even if not all that cash comes at close. That's a simpler transaction than a financial buyer, which, you mentioned is a number of different kinds of buyers.
And even with a strategic buyer, you're highly unlikely to get every dollar on the closing date, right?
That's right. Yeah, that's right. You might get most of it, but they're going to hold back some, probably in escrow, for some specific performance or to make sure that some things come through the way that's been suggested, or if there were some things that couldn't get nailed down at the time of the closing of the transaction, that sometime in the next year or 18 months, those things need to occur or not. If they do occur, then they release the escrow and you get the balance. But look, the buyer wants to de-risk the transaction. One, quite literally, maybe they're buying representation and warranties insurance to make sure that, anything that they kind of haven't unearthed in due diligence is covered so that it doesn't become a liability. But they also want to make sure that, they've covered eventualities, right? And so they want some period of time to pass in case there's something they didn't diligence. And in case there's something that they wanted to kind of hold out for, that you're still kind of tied to the business for some period of time.
Now, and just taking a couple of steps back here, clients that are in this space that we're describing here rarely come to me to explore the alternatives of ranges of transactions that they might enter into, the typical buyer. With smaller companies, they may be existing clients of mine, and I can kind of counsel them through the different alternatives that they're gonna have. With deals that where you and I may both serve the client, they're going to talk to Kirk first, right? That's what I want them to do, to explore the alternatives and make sure that they get the most valuable transaction, the one that suits their company the best and the one that suits their own personal needs the best, right? Talk to Kirk
Right.
first.
Well, and look, I appreciate that, David. And I would tell you that, the reason that it's useful for them to talk to a transactional professional before they say yes, are kind of multi-part. One, it only gets worse after you sign the LOI. Like if you're selling your company, you've lost all leverage when you sign the LOI. So if you do that before you've gotten any counsel around whether the valuation is right, whether you might get more and better terms in a competitive process, or whether there are some ambiguities that you need to get ironed out and clarified, it rarely makes sense to sell to the first company that reaches out to you. Now, sometimes founders are afraid that they're going to chase away a willing buyer if they retain somebody like me. And what I told a new client last week was, if the buyer is serious, and they're willing to pay you full value for your company, and they're not just trying to kind of snatch it up cheaply, then my involvement isn't going to bother them. They may not give me a warm hug, and they may be a little prickly initially, but generally speaking, I've found that serious buyers aren't bothered by transactional professionals getting inserted into things to keep things honest.
It should help the process, frankly.
That's been my experience. I only have my perspective, but the good news for my clients is that I've been a buyer of businesses and a seller of businesses. So, while both sides come at it with different objectives in mind, the big picture objective about getting a transaction done is aligned, right? So if you got a willing buyer and a willing seller, then valuation and terms can be worked out.
Mm-hmm. And you're kind of the reverse Darth Vader. You've been on the dark side, and now you're with the Jedi, the rebels, right? And now you know the secrets of the dark side. You know how the deals are going to work behind the scenes for the buyers, the financially sophisticated transactions. With strategic buyers right now that we're calling the more simplified transaction, are you seeing more asset sales, mergers, stock transactions? With the changes to the tax code, everybody is making more of a push towards stock transactions. But tax-free combinations, are you seeing a different marketplace these days?
Well, I'm definitely seeing. So I think that the changes to the tax code you're talking about is the proposed increase of capital gains taxes to essentially where ordinary income taxes are, which would dramatically reduce proceeds to anybody who's selling their company right now. And while there will probably be some horse trading, some batting back and forth in Congress and Senate to what eventually happens, it seems pretty clear that capital gains tax rates are going to go up probably next year, right? So there is, in addition to the fact that there's somewhere in the neighborhood of $1.5 trillion to $2 trillion held by private equity firms and SPACs and strategic buyers to do deals, which creates a lot of tailwind to the M&A markets to begin with, the urgency of trying to get deals done before year end to avoid having to pay higher capital gains taxes have caused lots and lots of people to try and head to market. There's definitely some preferences that sellers can have for whether they want to try and do a stock transaction, have somebody buy the company outright, including all of its liabilities and everything that comes along with it, Usually, if it's a private equity firm, they're going to want to do an asset purchase and pick and choose their liabilities and have the entity get wound down. After they do the deal, they'll create a new company to hold it. And some of that becomes like if you're a first-time seller and you have no idea whether somebody putting a stock purchase or an asset purchase on the table might have an implication for you from a tax and a liability standpoint, that there's one big glaring reason to have a transactional professional involved, because something like that can have a huge delta on your proceeds, especially on an after-tax basis, and maybe even the way you're sort of looking over your shoulder after you've sold the business about whether you've got any tail liabilities or something like that. So it can matter greatly.
In my experience of working with private equity firms and other financial buyers, taking a client that may have a relatively simple entity structure with owners, and then we're going to usually see the private equity firm or the financial buyer draw up something that's completely different with multiple entities and squares moving in every different direction, triangles. If there's going to be a financial buyer, if there's going to be a private equity firm and they're going to want to create new entities and flow through entities and that sort of thing, in that case, do you often see more asset transactions?
I do. Asset sales? Yeah. Absolutely, I do. And look, if you're an S corp or a sole proprietorship, it might not be that big a deal. But let's say you're a C corp. Not that I think a lot of the things you and I work on are C corps, but let's say you're a C corp. If an asset purchase is done because the buyer wants to be able to amortize the goodwill of the business over 15 years and write off part of the transaction so that they get some economic benefit through tax savings, then your entity, pays taxes on the deal, right? So your C corp pays, let's call it around 30% taxes in California. And then what happens is you as an owner and or the other shareholders of the C corp then on those net proceeds, so the remaining 70%, pay your full share of capital gain and state income taxes. So while it's not completely double taxation, it's a big hit, right? You might give up as much as 55, 60% of the proceeds to taxes if you're a C corp, you got an asset purchase. Yeah. Whereas if you could talk the buyer into making that a stock purchase, then all of a sudden that second layer of taxes goes away, right? Yeah. And if they're worried about your liabilities, they can buy rep and warranty insurance, or you can split the rep and warranty insurance. You get more money after tax. They want you to get more money after tax, right? They have to pay you the same gross amount either way, right? So part of the conversation in a deal like that, David, is around, well, why would the buyer want to structure it like an asset deal? And is it because of the liabilities, or is it because of the tax piece? So there might be some pliability there, if you're not going to get the same economic benefit.
My philosophy, to be blunt, is that you can paper a transaction, you can structure the deal, you can allocate the risks, you can do whatever holdbacks are necessary, so that you've got basically the same sort of allocation of risk as if it were an asset sale. And don't worry that you're going to be able to take it out on the seller if there's unknowns out there. It's usually the taxes that are the immovable object here. But moving along here into the heart of this discussion, the financial buyers. We've got different forms of entities out there, or different types of financial buyers. Could you describe for the listeners the different types of financial buyers, the traditional private equity firms, the family offices, growth equity, structured equity? What are these different types of buyers, and are they looking to do different types of transactions?
Yeah, so great question. A lot of complexity there. So putting them into kind of buckets. Traditional private equity firms that have funds where they go out and raise a bunch of money from investors and then make, half dozen to 2 dozen investments for each fund that they raise, and they're out in the market every 3 to 5 years to raise more money. You know, those kinds of private equity investors are looking to generate, you know, returns by buying into your company, adding capital, strategic guidance, operating expertise, building it up, selling it in somewhere between 3 and 7 years, and then you know, not only generating a return on the invested capital, but then they get what's called carried interest or a performance fee on that. So those buyers very definitely want, chances are they want you to hang around, and or have your successors hang around to run the business, because they're not operating people. They don't necessarily want to absorb your business into their larger structure. You know, so those buyers are trying to generate an outcome or a return for their investors, and they're probably going to pay you some cash. They're going to have you retain some equity. They might have you take back a seller note, and they might add in something like what's called an earnout, where you get paid more money if certain results happen in the future, but those payments are contingent. You know, and then you've got two other kinds of private equity buyers that kind of you know, use similar structure but come at it slightly differently. The kind of family office or long tail private equity investor isn't looking to necessarily resell your business in 3 to 7 years to try and generate their return. They actually want to get the cash flows over time. And they're more of kind of the Warren Buffett approach to private equity, the favorite holding period being forever. Just buy great businesses and hang on to them and get the cash flows from them. And sure, you're trying to improve them and make them more valuable, but you're not necessarily trying to generate, you know, a liquidity event with each set of funds that you raise from investors, right? So that's more patient capital. And then you mentioned structured equity. You know, that the way to think about structured equity or growth equity is they're like the first group of private equity buyers, but they're generally buying a minority stake. So they might still control the business, but they're not buying more than 51% of the business. And chances are they're giving you the ability, the founder, the ability to take some chips off the table, get some cash, but they're also injecting some cash into the business to grow, to do other acquisitions. And then the two of you will participate down the road in a second bite of the apple. And I'd throw in another group, and maybe you were heading in this direction anyway, and that is SPACs, or special purpose acquisition companies. So these are essentially a way to kind of become a public company through the side door. You've got a SPAC promoter that goes out, raises a bunch of capital from mostly wealthy investors, you know, professional investors, institutions, and then goes on the hunt to try and find a really successful small business that they think, if they can buy it at a private market multiple, and then take it public at a public market multiple, get that multiple expansion, that everybody's better off. And then they take a pretty large percentage of the equity in that, ultimately the public entity, and they take some pretty healthy fees along the way. So the promoter of the SPAC very definitely makes out well. You as a seller, depending on what you want to do, definitely have a monetization event. You get valuation increase if all goes well. You may or may not have a liquidity event. And what I mean by that is essentially you become probably the largest shareholder in a thinly traded public company. So you can't exactly sell all of your stock 3 days after the public offering. You have restricted stock, and you're now going to be running or a significant shareholder in a public company. But there's around 300 SPACs out there right now, David, that are looking for successful private businesses to buy. And so they're becoming a pretty important part of this kind of private market capital structure.
You mentioned one common term in private equity that private equity, it's used every day, but to the ordinary business owner, they may not know exactly what carried interest means and what that term means to the seller. What does that matter to me? If you're going to earn your money in some sort of financially finagled way that I don't, it doesn't matter to me. what's carried interest, and how should the seller be looking at carried interest?
Yeah, so the seller, in some sense, doesn't really care that the buyer might have a structure that allows them for carried interest,
Mm-hmm.
but it does get to the buyer's motivation, right? So if I'm a private equity firm and I buy your company, and my goal, if I buy your company for $10 million, and my goal is to sell it for, you know, 25 to $50 million, right? Then the way I've structured things is that my fund charges management fees. That's
Mm-hmm.
how I keep the lights on at my private equity firm. And if I pay you, my limited partner, my investor in my fund, a
Mm-hmm.
certain amount of what's called a pref, or preferred return. So let's say that for the fund, or for each investment in the fund, if I generate, say, 8 to 12% per year that I pay out to you,
Mm-hmm.
after payment of the pref, whether it comes in 3 years, 5 years, 7 years, so after I've charged management fees to you and after I've paid you the pref, whatever the difference is between what we're selling the company for and that, you know, kind of further sale down the road, and what I paid for the company in the first place, plus the management fees and the preferred returns, whatever that differential is, I get to keep a piece of that, usually 20%. That
Okay.
20% is called carried interest. And the reason that private equity firms and the owners of private equity firms are so wealthy in many cases is that carried interest is not taxed as ordinary income, even though it's their day-to-day business,
Mm-hmm.
because they've held it for more than a year in most cases. They're taxed at capital gain, and that's got a real multiplier kind of effect on their capital.
Mm-hmm.
So, you know, private equity generally makes a lot of money through carried interest. They have to make their limited partners, their funds, a lot of money to get a lot of carried interest. But, you know, it's important to know, if you're a seller, that that's their motivation, to buy your
Mm-hmm.
company cheaply, to sell it for a lot of money and get a big chunk of the differential.
Yeah. Now, with most financial buyers, if a seller's going to be acquired by a financial buyer, shouldn't they expect a multi-step transaction? There's going to be some subsequent event that's going to be another liquidity event.
Yeah, absolutely. It'd be really, really rare for a financial buyer of any sort not to want to retain the founder, or kind of the founder and key management people,
Mm-hmm.
because generally speaking, they're buying a majority of the business.
Mm-hmm.
They're taking control of the business by structure, and they're probably incentivizing, you know, the founder or seller, and maybe even part of their management team, with carried or rolled equity in the transaction, right? So if the seller rolls some of their equity or retains some of their equity, you know, then the financial buyer, you know, is looking to keep them involved. One, to de-risk the transaction, right? As long as the founder stays involved, you know, key relationships stay intact and things keep going until the private equity firm can understand the business well enough to run it without the founder. But then also maybe to keep driving forward. Maybe the seller, you know, if you're a founder seller and say you're, you know, 40s or early 50s or even mid 50s, who
Mm-hmm.
says, look, if I could get some more capital, I could acquire two of my competitors and then hire more salespeople and go after, you know, some non-US business and some other channels, and I could grow this thing 3 to 5 times where we are now. Well, that's music to a private equity firm's ears. You know, they're going to want to do a transaction with a motivated seller like that all day long, and then participate in what is the seller's second bite of the apple, and of course their first liquidity event by owning the business. So that's really common in private equity.
When I worked with a lot of VC-backed companies, you know, tech entrepreneur that would go out and really just know their tech or know some way to monetize internet techniques, and that they would raise money and immediately be looking for the moment where the VCs would say, okay, now we need a real CEO. And it wasn't an insult to anyone. They wanted that. Yeah, now somebody who knows how to run a business, come in and make this thing valuable, and I'll ride your coattails. When a private equity firm comes in, they're not looking to make an immediate change of management. There may at some point be a change, but aren't they just more looking to make a more of a buy and hold investment like you're describing?
Yeah, so that's an important distinction. So first of all, for folks who aren't as familiar with the difference, venture capital is much earlier stage.
Mhm.
It's private money. It comes from limited partners. They have funds. So there's some commonalities between that and private equity. The way I think of the difference is that, private equity is not only later stage, but where venture capital is focused on what I would call concept risk. Is
Mhm.
it work? Does it work? Is it a business? Can it flourish? Private equity is focused more on execution risk. Can it be done better? Can it be done more profitably? Can it be scaled? Right. And so if you think about it, to be an early stage founder and take venture capital, your impulses and your ideas and your enthusiasm and your passion matter a lot. Those things don't really scale though. So unless you're the rare entrepreneur who has management talent and the ability to become good when you've hired that 50th employee and start to really make the company much, much bigger, chances are you're not the right person to keep running your company.
Mhm.
Um, you know, Whereas private equity, they want real executives. They want people that know how to run businesses. And
Mhm.
they're usually, if they think that a founder isn't the right person, kind of to run the business long term, they'll usually have that conversation in the due diligence period, and maybe even before they're in due diligence, to have a hard conversation with a founder and say, look, you don't really want to run this business long term, do you? We have an operating executive that we think we could plug in here
Mhm.
and do really, really well. And that operating executive is going to be kind of connected to the private equity firm, and so they're going to be reporting back to the private equity firm, and kind of do their bidding, if you will. Whereas a founder who's used to running their own company, especially if they've been running it for 15, 20 years, at some point is going to be pretty annoyed with the financial buyer who wants certain reports and wants certain reporting and wants to have conversations about things that the founder's been doing for a long, long time. And he doesn't want to
Mhm.
be questioned about. And so almost always there is a point where the seller, even if they're planning to work with the private equity firm until the second sale, there's almost always a point in there where they consider leaving or the private equity firm considers replacing them. It's common, right? So as a seller, you should just sort of kind of anticipate that you might run up against that at some point.
Kind of like with the prenuptial agreement, you don't need it to say when it kicks in. It's there, and you never know when you're going to need it. But that relationship is defined. And when you work with people who may just have some anecdotal, advice on selling their business that they may have got at the country club, or friends playing tennis, and they've heard, you will get more money for your business from a strategic buyer. They see that, a financial buyer is going to see ways to squeeze more value out of the company after they've been there and had a share of the ownership. Do you have to kind of disabuse them of these ideas and maintain some flexibility and know that it's kind of a case by case? There may be ways where you come out a lot better if you can stay on with a financial buyer and realize a portion of the value that they can bring to the table.
Yeah, great question. So, look, all of the things constant, the strategic buyer ought to be able to pay more for the business because they don't have to generate a return for their limited partners and account for management fees. And they've, got some scale economies already built in, right? So
Mhm.
the strategic buyer ought to be able to pay more, but I'm not so sure that they are paying more right now. I was in a process that just closed 2 weeks ago that has been going on for 9 months. We retained a great investment bank. There was a great management team in place. It was a fantastic business. Um, and of the 11 indications of interest we had, when we went out and started talking to potential buyers, both sending them out, kind of a teaser email with kind of a one-pager on the company, and also making phone calls to potential buyers. Two of the three lowest bids we got out of that first 11 indication of interest were from strategics. Financial buyers are really, really heavily capitalized right now. So they are in some cases outbidding strategics. So if the guy at your country club, who may or may not have gotten a great transaction, you don't know because he's the one there telling the story, right? Maybe 5 years ago, in the area of business that he's in, strategics were the better buyer, but maybe not right now, right? So, it's tricky to take that, anecdotal information and infer that there's always a hard and fast rule. Generally speaking, if you think that competitive tension can get, a higher price for the business, and that an advisor who can get out there in the marketplace and control a process and create some competitive tension between potential buyers, then you wouldn't want to limit the number of potential buyers, because that would limit the competitive tension, right? So if you say to your investment banker or your financial, kind of counselor or advisor in this case, I only want to sell to a strategic, well, that eliminates all the financial buyers, and there's that source of competitive tension that might actually be the more well-heeled part of things. So really, you need to be close enough to the markets for your specific kind of area, sector, domain, and the current sentiment in the market to be able to decide that.
We're seeing a hot market right now. We're seeing a very active market, and we're seeing some frothy valuations. Without telling your secret sauce or your specific market insight, why would you summarize in a nutshell? Why is it a good market right now? What are the good trends that we're seeing out there? If you're a seller, would you think there's a degree of urgency to get out there and seize this opportunity to sell in this good market?
Yeah, so there are a couple of things. So one, and the overarching thing, is that cost of capital is really low right now. If you're, whether you're strategic or financial and you're borrowing money, or you have access to, bank money, capital's cheap, right? And so it is in some ways cheaper to buy growth, especially with a little bit of leverage, than it is to create it organically by hiring more salespeople and rolling out new divisions and investing a lot in CapEx, right? So for all businesses, capital's cheap. That makes M&A activity easier, because private equity firms always borrow a percentage of the deal. But the other factors are things like, you mentioned one earlier, that if capital gains taxes are going higher next year, then that creates more frenzy right now to try and get deals done before year end. But there are a few other factors too. The pandemic actually kind of put a pause on a lot of the deal activity. So you had a good economy leading up to the pandemic, a lot of money raised to go do deals. And then the private equity firms that are now in a hurry to get deals done had to focus on their own portfolio and make sure they got through the pandemic. So they weren't as active out there in the marketplace trying to buy. And so they did that portfolio triage, and it took them 12 to 15 months to get back out in the market and start buying stuff, right? So that brings another thing into play, which is when private equity firms go out and raise capital, they usually have about a 3-year window to put it to work. And if they don't put it to work in that 3 years, they got to give it back to their limited partners, right? So what it did was take, a third to a half of their investment period away. So they're in a hurry to put that money to work in many cases. Not all firms, but some are in a real hurry to put money to work, right? So all that is creating a tailwind or positive sentiment to get more deals done, right? And, add in the SPACs. That's 300 new sources of capital that are out there, competing with private equity firms and strategic buyers. and then add in how people feel about the stock market. Do people feel like the stock market can continue to generate double-digit returns? I mean, would suggest that, you know, all this money going into cryptocurrency or all the money that's going into direct investments like private equity would suggest that people are looking for alternative sources of return. So if you're a seller of a successful small business, all of those things, you know, kind of inure to your benefit. All of those things create tailwind. So it makes perfect sense that it's frothy right now.
Mm-hmm. It sure does, and it's a good thing. So quickly, if we will, we've gone through a variety of different potential buyers. When is a good opportunity to use an ESOP? When is a company, suited for that? And would they try all the other alternatives first, or are some companies better suited for going straight to the ESOP transaction?
Yeah, so this is I see ESOPs considered a lot more often than they get used. So there are a couple of things. First of all, an employee stock ownership plan can be financed by the bank. It can be financed by the seller, or it can be financed, by both of those folks. And it can be for a minority or a majority of the business, or for all of the business, right? ESOPs work really, really well for project-based businesses or smaller businesses that won't generate, kind of that much in the way of proceeds for the seller. And what I mean by not that much is, let's say you run a business that does, 4 million of sales and, a million of net income, and you, the owner of that business, take half of that net income as kind of salary and distributions. So you're taking $500,000 a year out of a business that generates 4 million at the top line. Well, if you sell that business, it's only going to sell for probably 4 or 5 times, right? So you get $4 or $5 million, and when you're done paying what amounts to around 40% in taxes, you've got like $3 million left. $3 million is not going to generate $500,000 a year spendable return the way your business does. But let's say you can sell that business for $4 million to an ESOP. You might avoid capital gain entirely on that. So you might get to put some of that money to work for kind of your investment benefit, or to go buy a, kind of your bucket list boat or car. And you might be able to continue to take distributions from the business, because maybe you don't sell all of the business, right? There are some tax advantages to an ESOP. So, and maybe you, as the, kind of builder of that business, have some key long-term employees that, while you've compensated them well, they certainly don't have the kind of money necessary to be able to buy you out of the business. But you'd like to make sure that they continue on with the business. With an ESOP, you can do that, right? Because you all continue to be shareholders in the business. You go out and find a bank to help them buy you out partially. You avoid the capital gain, on the portion you get, and you continue to be involved in the business, and they continue to have their jobs. So, usually an ESOP is going to happen at a lower valuation than a sale in the marketplace. But for the kind of business it works well for, there's probably some tax advantages and some legacy advantages to the people that sell to an ESOP. And we have some great resources in town. We have some great ESOPs consultants in town. University of San Diego has the Beister Institute that does great consulting work on evaluating whether businesses
really good work over there.
Should. Yeah. So I mean, because Bob Beister, the founder of SAIC, was a big fan of employee ownership, and that was a huge company. It was ESOP owned. So it's a great way to maintain your legacy and keep your people intact. And definitely should be at least part of the consideration for any small to mid-sized business.
Kirk, as always, there's no shortage of information that you just shared, and we've saved some for the next time. As the listeners can hear, there's a lot of complexity to selling your business to the different types of transactions, the different types of buyers that are out there, that it can be a bit overwhelming. But there is someone who is on your side who can help you navigate the process and understand your options. And that is Kirk. And that is why you talk to Kirk first. So it's always a pleasure to have you on and to hear this wealth of information that you're sharing. As long as, we'll wrap up here. Is there anything among these different topics that you think that we should get out there now on these different types of buyers and transactions?
Yeah, absolutely. The takeaway I would have is that, look, chances are your network doesn't have the right resource to answer some of these questions. And I can tell you that the buyer of your business, whether it's a strategic or financial buyer, is a full-time predator, and you are part-time prey. And you owe it to yourself, whether you retain an investment banker or a transactional professional like me, get a talented M&A lawyer like yourself, David. You owe it to yourself to at least match up with your potential buyer by having some advisors who know what the market looks like. And I can tell you that our business is so busy and so active right now that we are certainly not trying to talk anybody into anything. So, give us a call, shoot us an email. If we can help, we definitely will. Chances are there's somebody in our network that can help. And, there's no reason to try and do this alone. And there's a whole bunch of reasons why that's a bad idea. So always appreciate spending time with you, David. I thank you for being on, and I love the podcast.
Yep.
Thanks.
Love having you on. You keep those wheels turning and think of the subjects to cover on our next podcast, because you'll be on again. I appreciate your time. And with that, this was Selling Your Business with David King. Thank you so much, listeners. Go check out the book, Selling Your Business, Begin with the End in Mind. We'll see you next time.